Trend trading strategies for forex, stocks, options, futures is a great way to trade. It's a traditional way to trade. Market wizards, turtle traders, so forth. And this can be good, but I'll tell you what, my friends, it can also lead to you losing a lot of money. And here's why. Trend trading used to be called, back in the days of yore when I started trading, used to be called trend following. And I still like that old term, not only because I'm old, but because I think it's more accurate. You don't know when you have a trend until it's already been established, and then you follow it. And that is the opposite of professional trading these days. These days, if you watch some of my other videos, and I highly encourage you to, you will see that I talk a lot about getting in before other traders get in. And trend following is the opposite of getting in before others get in. So, for example, let's just look here at this chart real quick. I'm going to show you a couple of examples of why it's so problematic these days. So we've got higher high, higher low, higher high. Now, so this all looks great. Okay, so now we have a trend established. Higher high, or I'm sorry, higher low. And then we get, a lower high though. And now we've got a lower low. So does that mean the trend is ended? And then we get another higher high. So that's one factor right there, is just by measuring higher highs, higher lows, is that's the way most people measure trend. That is not a good way of measuring trend. That is not a good way of measuring trend. And then the other thing is, if you follow to the trend, so as we talked about, then you say, okay, got to wait for a trend to be established, higher high, higher low, higher high, and then you get in on the higher low, but then, that didn't follow through. Now you get a lower low. So now do you think, now we have a downtrend. We've got a lower high compared to this. Actually, it's getting a little messy here, so let me get this more clear for you. So now we've got our first lower high and lower low. So now do we look to go short? Now that we have our downtrend established, so to say? Well, but there is no place to go short, and then it goes up. You see how confusing this can be? And then it goes down, and then it makes another lower low. So now we've gone from a higher high to a lower low. Gets very confusing. And then a lot of this can be subjective. Well, where do you measure a high? Where do you measure a low? What is a high? What is a low? Based on your subjective determination. So you need some sort of objective mathematical formula to identify highs and lows. That's the first thing. And by the way, I have another webinar on that. It's absolutely free. I give this away for free. And I use what I call my cycle indicator for this. And it mathematically measures highs and lows that are objective, mathematically based on the cycles of the market. You can get that free. I just recorded the webinar actually, so now you can access it 24/7. Go get it. I'll show you how to set up the cycle indicator and how to time your markets, make your highs and lows objective. So there it is, indicatorwebinar.com. All right, now moving on with trend though, then what happens? Then we get into this choppy stuff here. This is the death of traders. And, some people use candlesticks, for example, and they'll say, we've got a nice engulfing candlestick pattern here, and so that's awesome sauce, but not really. This is another way that people measures highs and lows, that they look for candlestick patterns, and then it goes down, but then it comes right back up again. So we break out of this little channel here, and then we come right back up. And so no bueno at all. So let's look at this from the way professional traders do it, which is not subjective chart reading, but objective statistics and probability. So here is something I'm sure you've seen before, the bell curve of probability trading. So the trend is actually the mean. And so when you're trend trading, you got to understand the trend is where the vast majority of the price action is occurring. And the market's making higher highs, higher lows, higher highs, higher lows, or the opposite around the mean of whatever direction the market's moving in. And so the trend, the longer the trend goes, let's say it's going this way, then the less likely the trend is to continue. This is why they say the trend is your friend until the end, in case you've ever been wondering, where does that come from? It's actually not just some slogan that doesn't mean anything. It's actually based on statistics. So the closer we get, or the further we get away from the mean, the less probable price is to move away from the mean, whether the market's going up or whether the market's going down. Think about that for a moment. The percentages, trends get started, they go away, and then they come back to the mean. They get started, and then they come back to the mean again. And this is why a lot of trends don't follow through, because there's always this pressure, this mathematical, statistical phenomena that the market will always have a almost gravity to the mean. Now that we understand that, you see we're trend trading, okay, well, it has its place for sure, but the market's only, and this is another slogan you might have heard before, another saying you might have heard before, that markets only trend about 20% of the time. Again, this model explains why. Now, since trading is all about probabilities and statistics and having an edge, why would you want to trade something that only occurs 20% of the time? That means the odds are not on your side. So what if we did the opposite? Do you ever notice how, have you ever felt, actually, let me put it this way. Have you ever felt like the market is always doing the opposite of what you think it should do? And I remember thinking when I was a young trader, gosh, if I just took the opposite side of all my trades, I'd be a millionaire. And if you ever thought that, this is why. There's actually something to that. Your subconscious mind is picking up on a truth, it's picking up on patterns. So what if we trade, instead of trading the trend around the trend, around the mean, waiting for it to go away from the mean, which gets less and less probable as time goes on, what if we waited for it just to get way the heck out here? Basically 2 standard deviations. When there's only 2 standard deviations away from the mean, then that means we've got about, well, we got a dramatic increase of the probability, and this is what we call reversion to the mean trading. It's the exact opposite of trend trading. So again, if you do the opposite of what you've been doing, maybe you'll get the opposite results, and you start making some money. Imagine that. But it's pure statistics. It's pure probability. Reversion to the mean trading. It's a skill. It goes all the way back to the good old bell curve that you probably learned in preschool. Well, when I was a kid, we didn't have preschool, but you get the idea, hopefully. Anyway, I have a trade set up based on exactly this. It's a reversion to the mean trade. I call it the rubber band trade because it's like a rubber band pulling away from the mean, and it stretches, and eventually it's going to snap back here. And it's a super high probability trade. So there is the link to it, and go get it. And it's a free trade I give away, by the way, and I do this because I understand you have a lot of people that you listen to, a lot of teachers that you watch and so forth, and you don't know who to believe. I totally get that. So I figured the best thing to do for me was just to give you a trade, have you make money from it, give it to you for free, teach it to you. There's 5 video lessons in this, and make money. And if you don't make money, well, you haven't spent any money in the course. And if you do, well, then of course, that's always a great thing. So go to it, rubberbandtrade.com. Enjoy my gift to you.